Hello, and welcome to another episode of Franchise Business Real Talk. This one is in regards to something that I think will be of interest to anybody that's considering buying a small business. So, prospective buyers of franchises, or any small business for that matter, or people that have a small business or a franchise unit or two or 10 that they're thinking about selling. And the topic is seller carry. What do I mean by seller carry? You've probably heard it a lot, and maybe some of you don't know exactly what it is. Seller carry is where the seller of the business loans a portion of the purchase price to the buyer. Just to kind of put that out there right away, is I've done this 4 times on our businesses, and it's always worked out well. So I do have a positive bias on this, but I do know people where they've had some challenges with it, but in the end, it ended up being good anyway. I'm not trying to sell you on seller carry. I'm just trying to instruct you on it, give you some guidelines to go on and some numbers to think about. So before we get into the numbers, though, there's pros and there's cons, of course, and there's pros for the buyer and there's pros for the seller as well. So if you're a seller or prospective seller, I'd like you to consider utilizing some level of seller carry, whether to a large degree or to a smaller degree. Because frankly, even if someone got a bank loan, you might be required to carry some of the loan. But I have seen it as a terrific tool for income production, increasing the size of the buyer pool and the competition for the business, and just helping someone along that may not have qualified through a traditional way, but might be the best qualified person to run the business. For instance, I sold one of our fitness centers to the manager and our best performing personal trainer. I knew that they could run the business. They hadn't been in ownership, but they've been in management and operations. So that was a relatively easy one for us to provide financing to them. So the pros for the sellers, to summarize it, and there might be more that I'm not thinking of, but number one is you increase your buyer pool because not everybody has to have the same level of financial qualifications. Probably quickens the whole selling process. You might be able to have someone that really knows the business, but isn't financially qualified um, as the buyer. And there's also interest income earning potential as well, which is can be a big deal depending on the purchase price. The pros from the buyer side are you don't have to qualify for a bank loan. That is not that easy these days. You might qualify to run a business that you know really well and own it. Um, and you're going to be able to buy this for less money out of pocket and potentially for a lower cost overall. So the cons for the seller is you might get the business back. That's about the worst case scenario. And depending on the capital in the business and the equipment in the business, you might get the business back with no goodwill left, and you might have to rebuild it up again. My thought on that is if you've done it once from scratch, you can kind of come in and look at like the guy or the gal on the white horse that's coming in to save the business. Probably works better in smaller communities than large urban communities where people don't know each other as well. So that's something to consider. Another con is if you had a business broker and say they have a 10% commission on that, you need to get at least that amount as a down payment or work that out with the business broker up front. Like, hey, I'm offering a lot of seller carry on this. We're probably going to get a higher purchase price. You're going to make more money, but I need you to take some of your commission over time. And I know business brokers aren't generally happy about that, but it might make sense for them as well. Because they don't get paid until there's a sale, and more buyers usually means a quicker sale and a better sale for the seller. Um, Another con is you're waiting for your money and it's at risk. So those are some of the cons from the seller side, and I don't think there are really any cons from the buyer side. You're getting in cheaper, faster, easier, no bank loan, or maybe helping the bank loan along. So it's something very much to consider, and it's something very much to, if you're making an offer on a business, to make an offer that makes sense for you based on the payment you think the business can afford, and see if you can get into that business quicker than other buyers might be able to. Speed of the deal is a big thing for a lot of sellers. There's an emotional um, context to this as well. I think once someone decides that they want to sell a business, they really want to sell it and move on. That's another con from the seller's point of view. You're still kind of tied to the business. Um, so that's something I didn't add earlier. But um, just for example, if you had a business, a $400,000 deal, and you're gonna, as a seller, you're willing to carry 90% of it. So you're going to carry $360,000. You're going to take care of your business broker, unless he or she is along for the ride on some of the carry. And what we have done is we've set up the amortization over 10 years. That's what we base the payment on, over 10 years, but there's a balloon payment after 3 years. Why do you do that? Number one is it lowers the cost of the monthly payment for the buyer. So in that case, $360,000, say you're charging 8% to the buyer, you're going to get about a $4,300 payment every month, a little over that. And in 3 years alone, you've made $46,000 just in interest. So you're actually adding to the purchase, your sale price, by carrying the interest and exposing yourself to some risk. Now, what we've done is 10-year amortization keeps the payment lower, balloon payment at 3 years. At that point in time, we have escalating interest rates. So might go up 2%, might go up 4%, whatever you can step it up any way you want. But this is motivation for the buyer to go out and refinance that, and then you get cashed out, unless they want to pay a higher interest rate. I've had that as well. I had a gentleman that bought one of our businesses. I think we started the note at 8%, 3-year balloon payment. He was busy doing other things. The interest rate went up to 10%. He's fine with that. The next year it went up to 12%. I called him, said like, "Hey, you want to refinance so we can get some money out of this, or do you want to keep on paying it at a higher interest rate?" And he's like, "It's not worth it for me to refinance. I'll just pay a higher interest rate." So at the end, we were making 12%, which is pretty good interest, and he was good for it, and paid it all off, and it worked out really well. So, the thing to consider is the motivation of the seller. If you really want to get out quicker and maybe at a higher rate, because usually there's about a 20% discount for an all cash deal. And in this way, you can attract more buyers, maybe look at a higher price, but you're offering this great financing. And on the buyer side, I would say, the other thing to consider is if someone is completely unwilling to carry, that's a little bit of a red flag for me. Um, that's me personally, because I've always been willing to carry a part of the purchase price. But if someone's adamantly against it, I would wonder if they know something that you don't know about the business, the upcoming, maybe there's something going on in that community, especially if you're new to the community. They might know of new competition coming in. They might know of something, regulations going to change or something like that. Because one of the best things about seller carry from the buyer side is the seller is very motivated, very much still has skin in the game, and they really, really want you to succeed. They might want you to succeed anyway, right? But they have a financial reason for you to want to succeed. That really helps out with transition. We recently had a deal um, in our system where there was no seller carry, and um, everybody got along until the day of closing. And the day after, the seller and the buyer were seemingly mortal enemies for some reason. And that made the transition way, way tougher. And I kind of kicked myself for not recommending this more strongly to the seller is all I'm sorry, to the buyer is always request some level of seller carry so that at the very least they're going to help you with the transition. There's lots of non-financial things that go on in a transition post sale, employees, vendors, landlords, things like that, that it really helps to have the old owners um, participation in for sure, and certainly not someone that's trying to block block you every step of the way. So I think it also helps out with that transition aspect of it, and knowing that the seller of the business is still going to be there to help the new owner, because even if it's a great running business, there's always little things that are forgotten, and cooperation certainly helps. So to sum it up, seller carry, I think it's a great tool. If someone asks for it and you're the seller, please don't write them off as someone that just is trying to buy your business with your money. That's not the case. They might be the perfect buyer for your business. So that's the deal on seller carry. If anybody has any questions, please reach out to me at guycoffey@gmail.com, GUYCOFFEY@gmail. And I'm happy to help and step in any way and answer any questions. And I hope this helps you.